But do I have a sense all five of you seem to think that if we see many of these social policies enacted, health care reform being, I assume, the biggest one, that would kill any long-term round?
Cap and trade.
Cap and trade, Peter Schiff, all the spending.
Well, obviously that's going to make a bad situation worse, but we're even further out on the leverage limb than we were a year ago.
What is this debt obsession?
And rates are going to go up. They can't stay down.
Debt is the only measure of how we're doing.
The Fed has parked a lot of bonds on the books of the banks, and they're sitting on them. Let's not say we're all leveraged out. It isn't like, you know, the consumers haven't been working down their debt and all the rest of that.
They've started. They've gotten started, but with, you know, they're nowhere near in good shape.
How long is it going to take,
We've been on a
Peter Schiff?
spending binge for a generation.
So
we
how
just
long does it take for the consumer to get back to where it was?
Spend money for a generation? Come on.
No,
we've
got to save money. We got to get our savings rate up to 10 to 20% and keep it there for a long time.
But Peter Schiff, how long?
Peter Schiff, did you look at the GDP data that was released this morning? There was an amazing thing which I want to throw out as a challenge to you. Do you realize that the consumption share of GDP hit all-time highs this last quarter? What that means is that this theory that the consumer is just completely falling off a cliff and will never come back, and we're going to be in 25 years of scrimp and save, has simply not shown up one iota in the numbers.
So it's an interesting theory,
but as scientists, it's not in
we're digging
the
ourselves
data.
into a deeper hole. This is going to come to an end. You can't run an economy on spending other people's money. You run an economy on savings and production. We've got it completely backwards, and that's why we're in trouble.
And we're saving.
But we're not spending other people's money. We're investing other people's money.
Let's make this actionable.
This money.
Jerry Boyer, what do you do right here based on what you believe about the market?
Well, if you're not in, you might want to wait for the next little correction before you get in, but I think we've got another little bull coming. And if you want to know where, I like technology because it's going to be a jobless recovery. Peter will get his inflation down the road, so you might want to start to get ready for that.
Peter Schiff?
Well, look, you can't be in cash and you can't be in bonds, so you got to own stocks. I just own stocks abroad. I mean, I think you got to be in Asia, you got to be in China, Hong Kong, Singapore.
Oh yeah, China.
You got to be in natural resources.
Peter, if America falls off the cliff, who's going to buy all of China's little lead paint toys?
Silver up 50 cents, gold was up 20 bucks. I mean, that's where you got to go.
Yeah, Russia and China, very stable. Great place to put your money.
How about
who's China going to sell their exports to, Peter? Who is China going to sell their exports to?
They're going to buy them themselves. They're going to buy them themselves.
Oh, yeah.
Don Luskin.
I want to know, what is the China story if the U.S. isn't there to be a customer? The idea that all of a sudden the Chinese are going to turn into a consumer society is just simply wishful thinking. There's not the slightest bit of evidence for it. It's an idea, it's a theory, it's interesting, it's a great narrative, but where's the data?
They can buy their own stuff. There's 1 billion Chinese. As long as their government stops buying our bonds and stops suppressing their own currency, you're going to unleash massive purchasing power in China.
That's a big if.
Because American government could have bought this mortgage security at a discounted value, so when the housing market recovers, that could have been a very good return for the U.S. taxpayers.
Peter Schiff, I hear you chuckling already. I know you're opposed to this plan. You've argued we need a recession to solve our economic problems. Is that where we might be headed?
Well, I'm just laughing about the housing market recovery. I mean, we've got a long way to drop with or without this plan. I mean, part of the problem is housing prices got much too high. They're still too high, and they're going a lot lower. And, you know, people shouldn't be borrowing money to overpay for houses.
All this fear about debt, is it fear-mongering?
It is fear-mongering, and thank you for noticing that interest rates were much higher a decade ago than they are today. The United States government does not have and is not going to have a problem financing its public expenditures and its deficits. It's simply not an issue that should be on our list of things that we really care about right now.
Peter Schiff.
Well, you can see that I'm laughing. Well, basically, you know, the reason that this is happening, it's not magic. The U.S. government is making the same mistakes that subprime borrowers did when they were using teaser rates on their mortgages. We have a $12.5 trillion debt, as you state. First of all, that doesn't include any of the off-budget items like the debt of Fannie and Freddie, and it certainly doesn't include the unfunded liabilities, which dwarf that number. But if you just take the funded debt and you look at where it's going to be in a year or two, it'll be around $15 trillion. What happens if interest rates go up to 10%? which is half of where they were in 1980. All of a sudden, we're paying $1.5 trillion a year in interest on the national debt. You see, the term on the national debt, the maturity is very short. The government is not borrowing for 30 years. The government is borrowing for 30 days. There's a lot of short-term paper. This is a teaser rate on an adjustable rate mortgage, and we are headed for disaster.
Now he makes a case there, Professor Galbraith. What's your response to that, likening it to a subprime mortgage and fairly pointing out a lot of this debt is short-term borrowing? It's got to be rolled over.
Yes, but the government can, in fact, borrow for 20 years at a rate which is now running at 4.5%.
No, not if it tried to do it. If it actually tried to do it, rates would go up.
Well, that's a rate which tells you that the capital markets are not, in fact, worried about this, whatever this actual scenario is, that somehow the capital markets are going to turn around and say that the U.S. government cannot finance itself.
The only reason,
of course, it should finance itself. If it can finance itself for the short term at zero, it should do so.
No,
perfectly reasonable thing to do.
The reason that the federal government isn't borrowing in the 30-year bond market is if it tried to refinance the short-term debt long-term, it would destroy the bond market. Bond prices would collapse and interest rates would go through the roof. The only reason long-term rates are so low is because the government isn't borrowing at the long end.
Peter, what about the question, though, that part of this comes down to there is a pool of money out there and it wants to go somewhere it perceives to be safe. So the U.S. may have a problem, but I mean, look, Greece has been in default half the years it's been in existence. Spain, Portugal, you name it. I mean, the U.S. may be bad, but it may be better than anywhere else, and maybe that's why rates are low.
Greece didn't have it. Nobody was talking about Greece's problem 6 months ago. All of a sudden, it's a problem. The United States is the next Greece. You know, we're going up the food chain in sovereign credit. We are the worst offenders. We owe the most amount of money to the most amount of people all around the world. We have this giant credit bubble, and when it began to burst in 2008, we didn't solve the problem. We made it worse. We have a much bigger problem coming in the years ahead when the U.S. government bubble bursts.
The difference between the United States and Greece is that Greece is a member of the euro, and Greece has to fund itself in a currency that it cannot control. The United States is in full control of its own currency.
Yeah. But that's the bigger problem.
We can have some problems. I'm not just saying that we are free, we've solved all economic problems. I'm saying financing the government of the United States is not one of the problems that we face.
Sure it is. See, the fact that Greece can't print money, that's a good thing. The fact that we can print money to repudiate our debts with inflation, that's not a good thing. Anybody who's holding U.S. government bonds, basically what you're saying is, it's okay, the government's going to print a bunch of money,
as I say
you're going to get paid.
If the markets were seriously worried about the prospect of inflation, they would not have a 4.5% rate on 20% bonds.
Look, just like the markets didn't see the subprime problem until it was too late. Look, gold is at $1,100 an ounce for a reason. It didn't go from $250, 10 years ago to $1,100, $1,200 without people worrying about inflation.
Since 1980, we go to that problem. It doesn't look so good.
So you're telling me that this is all tied to the price of gold as the oracle that we should be following?
Well, you should be following something. Don't be following the Federal Reserve. To say that because interest rates aren't high, the market has consistently gotten things wrong. I was on this network, CNBC, back in 2005 and 2006. Warning about the housing bubble, the collapse that was coming, the problems in Freddie and Fannie, the problems with the financials. No one believed it. People were laughing it off. All of a sudden, these things happen.
That if the markets truly are as inefficient and irrational as you say, then we should tax them and we should regulate them to a fair
level. Well, they're already taxed and regulated. That's part of the problem.
Let's take a pause there.
Peter, if you had to choose, which are we closer to, Greece or Japan?
Well, man, out of Greece, Argentina, Zimbabwe, we're nowhere near Japan. We're not going to get off that easy. See, when Japan started making its mistakes, it did it with a position of strength. The Japanese had significant domestic savings. They had huge trade surpluses and current account surpluses. We're at the opposite situation. We've exhausted our domestic savings. We have a huge trade deficit. We can only borrow money if the Japanese and the Chinese and the Saudis lend it to us.
But importantly, we have inflation at 40-year lows, and we have a very high rate of underemployment or employment.
The Fed's balance sheet has grown by 150% in the last 2 years. That is massive inflation. The fact of the matter is that prices should be falling in the United States. They're not. They're rising instead, despite despite that, because of all the inflation that's been created by the central banks. And, you know, when foreigners wise up, when they stop buying our bonds, you know, then you're going to really start to see a collapse in the value of the dollar, and prices are going to be going through the roof. And that's also going to send interest rates up, and that's going to really exacerbate the ability of the U.S. government to pay the debt, because we've got it all financed with Treasury bills. But when interest rates go up, it's impossible for us to pay off the debt without printing even more money.
Mike Musa, do you see that?
No, I think we're about 6,000 miles from Japan and about 6,000 miles from Greece. Our situation is not in any way comparable to either one.
Why do you say that? Explain.
Well, we are growing much more rapidly than Japan. Japan grew 1% in the 90s, grown 0.5% this decade. We grew 3.5% in the 90s. Even with the deep recession, we grew 2% in this decade. So we're much stronger there. And as far as Greece is concerned, we have a record of fiscal probity, having brought our debt to GDP ratio down several times in the post-war period.
Yeah, you know, first of all, we're not actually growing. Our economy isn't growing. The GDP is going up because we're spending borrowed money. But all we're doing is spending more. It's not our economic output that's increasing. Meanwhile, our debts
most certainly
are
is our economic output that's increasing. We're
it's
growing,
not.
as the NABE suggested, 3% this year. I think probably 4%.
Yeah,
and we will have a relatively normal cyclical recovery. To say otherwise is just a lot of nonsense.
No, it's not nonsense. All
yes,
we're doing
it is. Absolutely.
No, the government is spending money. Consumers are spending money. It's not economic growth. We're destroying our wealth. We're going into debt. The debt is rising much, much faster than these phony GDP numbers.
The GDP numbers are not phony. You're just speaking a lot of nonsense.
No, I'm not. I mean,
yes,
that's
you
what
are.
people...
Absolutely.
Look, I don't speak nonsense.
Yes, you certainly do. If you say that our gross
Mike,
domestic product is not growing,
because
you just don't know what you're talking about.
No, the GDP is growing because it's made up of government spending and consumer spending. But where are they getting the money to spend? We are borrowing
Government
it. And
spending growth accounted for about 1/10 of GDP growth over the last 4 quarters.
Well, all this money that the government is spending, you don't think that's part of the GDP? It's a lot more than that.
Okay.
All
Real government purchases about 10%
the money that the consumers are spending, they're getting from the government.
Yeah, first of all, Simon, you have to understand, when you talked about the fact that a borrower, when he gets to refinance his mortgage, he wins because he has lower payments. Well, that's a zero-sum game because the lender loses. His cash flow is diminished by the same amount. Now, the problem is you've got all these banks that own these low-yielding mortgages. They're surviving right now because the Fed is making up the difference by giving them money for free. But when that bond bubble bursts and the Fed is forced to raise interest rates, and all of a sudden rates aren't zero, but what if they're 7%?
How about the velocity of money? Hold on a second. I mean, you've got consumer spending, you've got banks that are getting money cheaper from the government, they're lending it cheaper. Money is churning through the systems, exactly what the Fed wants.
No, but you're missing the point that we are putting ticking time bombs on our financial institutions. They're holding 30-year paper where they're yielding 4 and 5%, but they're borrowing money for nothing from the Fed. When the Fed raises interest rates...
But your assumption, again, is that the Fed is about to blow up.
At some point in time...
for consumers. They have more money to spend.
Let me finish my point. At some point in time, interest rates have to rise. And when they do, all the banks will fail because their balance sheets can't survive it. So we're setting up this explosion.
You were probably saying interest rates were going to rise, about 6 months ago.
Hyperinflation.
So are you going to tell me that we're never...
People said we were going to 5.
Are you going to tell me...
When are rates going higher?
Are you going to... Is it impossible that the Fed funds rate can ever get back up to, say, 7% sometime in the next 5 or 10 years?
Not in my lifetime.
So in your lifetime, in the rest of your life...
Not anytime soon, no.
We have to leave it there.
I got to ask Peter. That's just ridiculous.
The question, Michael, is just in case we end up with deflation, some people say there is a possibility of that. You have some money there because then that trade pays off.
Yeah, we can also be hit by a meteor.
That's exactly right, Michelle. And again, what I'm hearing is the case for broad diversification in this discussion right now.
Peter, I heard a funny snide comment there. What was it?
Well, I said, we could be hit by a meteor too, but I'm not going to prepare for that. We need deflation. Unfortunately, we're not going to get it. That would be healthy. What we're going to get is runaway inflation.
Well, we are getting deflation.
No,
wait a minute. We are getting deflation in housing
Where do you
prices.
shop?
We're getting deflation in a lot of asset classes.
But that's not deflation.
We're seeing deflation in real estate prices all over the country.
No, but that's not deflation.
We could experience.
No.
But Peter, and I agree with you on
that's
most
not
stuff.
deflation.
We could experience what Japan did. Japan had deflation for 20 years.
That's not deflation. If real estate prices are too high and they come down, that's not deflation. But you know what? The cost of owning a house is going to go up. Even though prices are coming down, utilities are going to go up. The cost of maintenance is going to go up. I mean, go to the grocery store. Are food prices falling? Go to the gas station. Where do you see consumer prices falling? They're not. They should be falling, given this huge contraction we had in the economy. But the Fed created so much inflation, prices are rising.
Suffice it to say, you don't think it's worth putting on a few percentages of your assets into treasuries for the just-in-case scenario? You don't think it's a possibility?
I would put 0%. Buying treasuries today is like buying .coms in 2000 or buying condos in Miami or Vegas in 2006. It is the sucker's trade of the decade. The only thing worse than owning U.S. dollars today is owning a promise to be paid U.S. dollars in 10 years or 30 years.
Okay.
Do not touch them.
Don't move.